Brought to you by Prescient Investment Management. Informed by science. Guided by insight. Prescient Investment Management is an authorized FSP.
Thank you, Chris. I must say it feels a little bit like coming home, talking to UCT students, because that's where I studied centuries ago, it feels like. So it's great to do this with you. And as Chris said, this is going out. So we're actually going to record it as a special podcast of Honest Money. So, you're welcome to listen to the recording later as well. And we'll be sharing it out to our listeners. So without further ado, to the UCT Investment Society, thanks so much for inviting me. And we'll be talking about your journey, or starting your journey to financial freedom. So maybe just why financial freedom, and what's that about, and why is it important? I think when we talk to investors who are starting their journey, one of the things is you can't kind of drive from Joburg, or let's say from Cape Town to Joburg, without knowing that you want to get to Joburg. You need to know your destination, and you need to understand that money is always a difficult conversation. In our country, we've got so many pressures when it comes to money. So many people that have to take care of family and kind of often an extended family as well, and the pressure on graduates is enormous in that context. And so the journey to financial freedom is difficult for anybody around the world, and in particularly so in our country, especially now with an economy that's struggling and investment markets that are tough. So I think to understand financial freedom, for me, what it means is getting to the point where in your lifetime, you get to have enough money so that you don't have to work for a salary to pay the bills every month. You get to the point where you can generate enough income from your own investments, from your own assets, so that if you're working, you're working because you choose to, because it's important for you to have purpose and meaning from your day, not because you've got to pay the bills and work for some boss you don't like in an organization that doesn't resonate with your values. And I think, the financial freedom for those who get there is hugely rewarding. And I'm not talking about always just about money. I think it's about, making sure that you can spend your time to align with your purpose and your values. And so that's what we're working towards. And I think probably 3 steps to financial freedom as far as I can see. The one is, step 1 is get to the point where you are debt free. And by debt free, I mean no credit card debt, no personal loans, no overdrafts, no car finance debt, and lastly, no home loans, no mortgages. All of those are paid off before you can consider yourself to be financially free. And that's step 1. Step 2 is once you have no debt, you will need an emergency fund, and an emergency fund will be 3 to 6 times your expenses. So if you're spending $5,000 a month, that means that you need $15,000 as a minimum, in a money market account or a savings account. That's not an investment. It's simply there, as something that helps you when the world falls apart and the unexpected happens, that you can draw on that cash to get you out of any immediate problems. And it's a step that a lot of people don't focus on. When they start their journey to financial freedom, they usually go, they might buy the point about getting debt free, but then they immediately start investing. And they don't build up the emergency fund. And the problem is that, if you invest in things like shares, which I'm a huge believer in, whether you buy individual shares in companies that you believe, or you buy a unit trust that invests in shares, or you buy an exchange traded fund that buys the stock market, all of those have the potential to give you a lot of capital growth over your lifetime, but they come with massive, the jargon is volatility. They come with the risk that over a short period of time, if you've got 10,000 Rand invested in shares, you might find that, you look at your statement 1 month and suddenly it's down and it's only worth 6,000 Rand. It's down 40%. That's normal for stock market investing. And if you have an emergency at that point and you've got no other way of accessing money other than to go to your investment portfolio, that means that you're going to lose 40% of your investments just because you haven't got an emergency fund. So I can't emphasize enough that life happens when you fail to plan, and that's the problem with money is you need to plan for the worst to happen, because unfortunately, that's what COVID taught all of us. I mean, many of you probably started varsity in COVID, and COVID's such an unexpected thing that would have been impossible to plan and predict. But certainly, if you plan financially for the worst, you can protect yourself against some of the big effects that might catch others out in a lousy time. So I think it's probably my biggest financial freedom tip I can give anybody is, get yourself debt free, get the emergency fund. And as I say, the emergency fund is 3 to 6 months worth of your expenses. And then the last step to financial freedom is building up your investment assets so that they can provide you an income to cover your costs on a monthly basis. Investment assets, a big word that covers lots of different things. So it could be anything from shares that I've already mentioned. It could be buying unit trusts, whether they're share unit trusts. Those are called equity funds or balanced funds or money market funds, and then through to property, whether it's physical property or property companies. All of those are investment assets. When you're making building an investment portfolio at your relative age, the one thing is you've got a huge amount of time on your side. Starting an investment portfolio, even if you're doing $50 a month with a platform like Easy Equities or on one of your banking profiles where they allow you to do small amounts of savings on a monthly or irregular basis. It's important just to get started, and I would be allocating all of that to investments that are solely focused on shares. And the reason is, over the next 20, 30 years, the stock market is the thing that's going to give you the best possible growth in the most predictable way. Over your investment careers, you're going to come across lots of new trends, I'm not calling them fashions because that's not fair, but new investment trends or new asset classes or new cycles in the whole business world. I think crypto is a great example now. Crypto certainly didn't exist as an asset class 10 or 15 years ago. And the debate about cryptos, hasn't died down yet as to whether they're an investment, a scam, just a speculative asset, or a real thing that that we should be piling money into. But the problem with something like cryptos right now is they're not predictable. They're not going to give you a high degree of certainty that you get capital growth over the next decade or two. Whereas if you buy a portfolio of shares that are in companies that that you understand, there is a measure of predictability there. And I think, I would encourage you to allocate a big portion of your savings to shares. If we just think about, what we buy and what we consume, whether it be streaming services, content, clothes, it doesn't matter. Most of those are companies that are about to list or have listed on a stock exchange somewhere. And if you're a gamer and you know that kind of the best games in the world, the ones that get the most attention are by Activision as an example, then that's the place you go, whoever the next gaming business is. And I think investing in companies that you understand might be an advantage, or you just say, I'm going to buy the whole stock market because I can't predict what the next investments are going to be or the best investments are going to be. And certainly for me, that's something I believe in. I think it's incredibly hard to make accurate investment predictions over a 10 or 15-year period. Lots of people might be right once. They could call a good share, or they could call that this is the bottom of the stock market. But over time, it's extremely difficult to predict markets, to choose individual shares with a lot of accuracy. Most of the time, the best performing investment in the stock market over a decade is the stock market as a whole. There are very few fund managers that can actually beat the market. And so, I think why not just buy the market and make sure that you're going to be right 8 out of 10 times. I remember, at varsity, if someone said to me, you can you can kind of get 80% for every exam without much studying, I would have taken that every day. And that's kind of what index investing is being right most of the time. Just going to have a look at the question, Chris. So we're talking about shares and that they're daunting. Agreed. Ankush, shares are always daunting, and the ability to get enough information to help you make a decision, for me, I think it's extremely tough. But let's just talk about, for example, buying the top 40 index in South Africa. That's something you can buy on your banking platform that allows you to buy shares. I mentioned Easy Equities already, or a platform like Satrix now. All of those would be places that you can access the top 40 index, and that's a really efficient, very low cost way to buy the whole stock market. And you can do the same in rands with the global markets. You could buy something called the MSCI World Index or the MSCI All Country World Index, and again, you can do it with small amounts of money. But with one investment, you've bought 1,200 different companies right across the globe. So if you find it daunting, don't feel alone. Most people do. There are entire investment businesses sitting all around you in Claremont and the like that and in Stellenbosch that specialize in choosing shares. And I can tell you, if they do incredibly well over a 10-year period, they're pretty accurate with 6 out of 10 of their calls, and 4 out of 10 calls that they make are awful. So those are huge businesses with really experienced teams of investment professionals. And for an individual, I think buying a unit trust or an exchange traded fund, to me, makes a lot of sense. I hope that helps. Keep firing the questions. They're really helpful. So I think for a journey to financial freedom, to me, that's maybe your starting point is, knowing what grows, and what doesn't grow is, I've spoken about your emergency fund, and if that's stored in a money market account or a savings account, it's there to protect you, but it's certainly not a growth investment. And the reason is interest that you earn on cash often will just track inflation. If inflation is running at 7%, it's amazing how closely correlated cash will be with that. The interest rates will be very similar. And the problem is that, interest, yes, it matches inflation, but the moment you pay any kind of tax, which is what we're all going to do when we earn interest, you're going to actually be losing money. So I'm not that keen on cash as an investment. I'm very keen on cash as an emergency fund and as a kind of a self-insurance. So you need to get growth assets, and growth assets most of the time are shares and properties or property companies. One of the things that most of you would have heard from family, friends, and the like is, when you start earning a salary, make sure that you use your salary to get a bond on a property. Buy a property, don't pay off someone else, some other landlords. Rental property. Rather buy it yourself. And I think that's an important point to talk about, because when I look at properties, there's the FNB have a property index, and ABSA used to keep a really good one. And the price of residential property doesn't really move much faster than inflation. It might be around 0.5%, maybe 1% a year faster than inflation over a long period of time. So people who tell you to kind of buy a residential property the moment you start working and the moment you can afford it, it feels like a good common sense thing to do. But just know that you're paying estate agents huge amounts of money. You're paying lawyers, huge amounts of money for, getting the bonds registered. Then you're paying levies to body corporates to maintain the properties, and rates and taxes. And then you might only own that property for 3 years because the first thing you can afford is probably a studio apartment somewhere. And the moment you start getting a bit more money and you make a bit more of an earning, you decide to move into a bigger place, 1 or 2 bedroom, and that incurs new transaction costs and new ways to lose money. So my view is, if you're going to buy a property because you love property and as an asset, maybe buy listed property companies on the stock exchange, or a property unit trust, or an exchange traded fund. I see Brendan and Caitlin asking about tax-free savings accounts. So let's explain them. So tax-free savings account, it's a stupid name for a great investment, because we all think if it says savings account, it must be a bank account, and it's not. So what it is all of us that are 18 years, or actually any South African individual can put 3,000 Rand a month up to a maximum of 36,000 Rand a year into a savings account or an investment account, which can then buy anything from a money market account, fixed deposit, through to exchange traded funds, unit trusts, individual shares, all kinds of investments. And the point about a tax-free is that you can contribute 36,000 a year up to a maximum of 500,000 over your lifetime. And all of the growth that you get inside that tax-free savings account is what it says on the box. In other words, it's completely tax-free. So, if you put money in there and it doubles and doubles again, what happens is all of that growth, when you decide to draw it out one day, will be completely tax-free for you. So I think it's an amazing investment. I think certainly, when you start, saving, it's a great place to build up your long-term savings. If you leave it there for a long period of time, and you let it keep growing, and they talk about compounding all the time. And I remember one of the banks had an ad saying, let your money make money babies, and that's what compounding is. It's allowing the money to grow on itself as well. Then in a few years' time, your tax-free savings account could be worth kind of a good few 100,000, if not a few million Rand, if you leave it for a decade or two. The one caveat to understand about tax-free savings is if you draw money out of your tax-free savings, you lose that capacity as part of your lifetime allowance of 500,000 Rand. So just to explain that, if over a 5-year period you've put in 200,000 Rand and you decide to draw 100,000 Rand out to buy a car, just know that now you will not be able to add that 100,000 Rand back later in life. You will have to, limit yourself then to 400,000 Rands worth of contributions. You'll never be able to make up to the 500,000. So whatever you do, treat your tax-free savings account as a long-term investment and not as a place to save money for a 3 or 5 year period. So for a lot of us, when we start work, we need to save for a car. And if that takes you 3 years to kind of build up the cash to buy a car, then please don't put that money in your tax-free savings, because that's that's a capacity that you're going to lose. Megan, talking about good debt. So there are 3 kinds of debt in the world as far as I can see. There is what I think is really bad debt. And that's things like personal loans, overdrafts, credit card debt, money to loan sharks, all of that, store card debt. All of that is really bad debt, because it's interest. It's charged at interest rates of kind of up to 25%, and unfortunately, there's no investment in the world that can grow at a guaranteed rate of 25%. So if you're paying a bank 25% interest on your credit card, all you're doing is you're making the shareholders of the bank rich, and unfortunately to yourself, you're going to have to really work hard to get that debt paid. So I think. That's the kind of debt we should be avoiding at all costs. If you're going to use a credit card, make sure you settle that debt at the end of every single month so that you don't pay the 25% interest. And then on the other side of the spectrum, you get good debt. Good debt for most of us in our lifetimes will be the money that we borrow from a bank to buy a house. So a home loan, a mortgage, whatever you want to call it. And the reason I say that is that, if you do buy a house, the likelihood is that house prices will at least keep pace with inflation over a long period of time. And any investment that at least tracks inflation, and you've borrowed money against that, you're at least finding something that's growing, at a decent rate. It's keeping value in real terms. And for me, that I would consider to be good debt. You also get a neutral kind of debt, which is for all of us in South Africa is going to be around cars. Borrowing money to buy a car because you need transport to earn a living. As long as that car is affordable for you, I would call that neutral debt. But if you borrow as much as you possibly can on the first day you get your first salary, and you've got nothing left to buy petrol, pay car insurance, rent, and all that stuff, then unfortunately car debt is bad debt as well. So I think, good debt is to borrow money to buy assets that are going to grow and either give you an income or at least grow at the rate of inflation or more. Jessica, your question. Student entering the workplace next year. Okay, so if you want to know how to break up your salary so that you set yourself up for financial freedom, the question will be how long you want to work for until you get to financial freedom. So, most people, entering the workplace, let's say at age 23 or 24, would say, well, I don't want to be old when I get to financial freedom. I want to have life, and that might be, let's say, 45. I know for most of you that sounds really old anyway, but let's just say 45. It's kind of just over 20 years of work. Then you probably need to save 33 out of every 100 Rand that you earn, Jessica. If you start work and they say to you, your cost to company is going to be 100,000 Rand a year, what that means is it's 100,000 Rand before you pay tax, before you pay medical aid and all of those things. Then what you should be doing is saving 33,000 out of that 100,000 every single year to try and get to the point of financial freedom. And that will get you there, I think, at about age 45 if you keep saving 33 out of every 100 Rand. The important point there is, you've got to control your expenses. So getting to start work, the longer you can stay debt free, the better, because that means that you're earning growth on your money. You're getting compound growth. You might be earning a bit of interest on your emergency fund, but you're not paying debt. You're not going backwards before you go forwards. And that's the problem with a lot of people who start life, and start work is, they get offered fantastic facilities, great credit cards, and they think, well, that's great. It's so easy to spend. I'm just going to spend. And then they wake up 5 years later, owe the banks hundreds of thousands of rands in credit card debt, and they've got no money for savings. So the biggest trick I could, I wish I taught myself out of varsity was stay debt free, try and pay for my cars in a 3-year period, and drive kind of the cheapest, smallest secondhand car I can find that's still safe. Brendan, do you have any rules or advice on how to structure an investment portfolio and its asset allocation? So I think, Brendan, just for everyone else, asset allocation is your combination of cash, bonds, property, and shares in a portfolio. And I think when you're starting out and you've got no debt, no financial worries in terms of people that you have to look after, then you can afford to take as much investment risk as is reasonable, and that means putting that money into the stock market is my best for you. I think you can go probably until kind of late 20s, early 30s. You can maximize your money in the stock market, and then later in life reduce that down slightly to around 2/3, maybe 3/4 of your investments in shares, and then the balance in bonds and property companies. From Craig, what would my advice be to someone with a student loan? My advice, Craig, is when you start work, pay the minimum required on your student loan. So make sure you service the debt every single month until you've built up your emergency fund. And the moment you've got your emergency fund at 3 months worth of your expenses, you redirect every single cent you've got into that student loan until it's gone. I might be a bit of a kind of a maverick, but I feel that if I've got debt, it means that the bank owns me. I don't own myself, and the bank can control me, and I don't want anyone to control me. So I'm going to do everything I can as fast as possible to be debt free. And that would be the best advice I would give you, as well as, I know student loans might attract a relatively low rate of interest compared to other kinds of debt. But the point is, there's still someone who's lent you the money, and you now owe them that money plus interest that's compounding against you. So I just think you get rid of the debt and then start saving. It's not a horse race where you need to reach a certain savings goal by a certain day or a certain age. It's based on your life and your circumstances. So your circumstances, you've got student debt. Get rid of the student debt, take control, and start building up your capital thereafter. Ronan, you were saying in class the other day, we learned about bonds. Do you think they're a good investment versus shares? Ronan, bonds over 100 years will grow at about 2% a year above inflation, whereas shares will grow at about 6% a year, even more, but let's just say 6% a year above inflation. So bonds are a good asset when you're looking for income one day, because especially if you buy high quality government bonds from high quality governments, the likelihood is that they will pay that income to you every single month, and they won't default on the debt, and you're getting some sort of inflation protection. But they're not high growth investments. They're not going to generate the really big capital growth that you're looking for early in your investment career. So I think they're a nice diversifier, and having a portion of your money in bonds at a young age, and I think that's maybe 5 or 10%, is not a bad idea. But if I'm starting out on day one, I would rather have 100% in shares, as I say, over and above what you've got in your emergency fund. Questions are coming in hard and fast. Ankush, I've heard hi Warren, I've heard about beating the market from books and movies. What does that mean, and should I try to do it? Beating the market. So the market in South Africa would be the all share index. In America, it would be called the NASDAQ or the S&P 500 index, and those are those are the market. So that means it's basically all the shares in the stock market. And there are companies that try and do investments that beat the market. So those are generally called fund managers, and they will try their best to buy a selection of shares that they think can beat the market. I think over a long period of time, it averages out that 2 out of 10 fund managers get that right, and then the balance don't manage to beat the market. So when I don't know what to do, I'll just simply buy the market. But if I feel that I've got strong conviction in a fund manager or in a selection of shares, then I might buy those shares or pay the fund manager to choose shares on my behalf. Personally, with my own money, I know I can't choose shares. I don't have that expertise. So what I do is I take half my money and I index it, and the other half I allocate to fund managers who I believe will do better than the market. As I say, knowing that at least only 2 out of 10 will get that right. Chris asking, what's my preferred ETF and why? My preferred ETF is actually 2, Chris. I can't give you one. If I'm starting out in your position as people entering the workplace next year, or maybe in 2-3 years' time, I would probably split my investment 50% into the top 40 index in South Africa. So something like the Satrix top 40. And then I would with the balance of the money put it into the MSCI World Index, and that's also offered by a company like Satrix as well. But if you start building up a bit more money to save on a monthly basis, adding a fund manager to that is maybe not a bad idea, especially a fund manager that manages money differently than the index, so that you get an additional diversification. Just checking if there are no more questions. No. So just back to kind of some of the mistakes maybe to avoid. It's likely that most of us are not going to start work, being gifted a car by our parents. So, one of the things that you're going to have to do to kind of get around and make a living is buy a car most of the time. If you can avoid it, I would say it's a good idea. But for a lot of us, that's not really an option when public transport won't do the job. So I think if you're going to finance a car, try and finance it over a short period of time. Try not to pay balloon payments at the end. Try and rather pay a deposit up front, and then if you can, pay off that car over 3 years. There is something about South African men, especially, unfortunately, where we just love to buy cars, and the more flash, the better, and that's a great weapon of wealth destruction. Cars are. They're only impressive when you drive them off the showroom floor, but after that, they're a great expense. So rather buy high quality second-hand car that's safe, that's small, that gets you from A to B, and that you can pay off as fast as possible. Spending big money on big cars, I know it's flash and it's impressive to other people, but unfortunately, it's not going to get you to financial freedom very quickly. Ronan says, why not the S&P 500 ETF. So for me, Ronan, the S&P 500 is only the 500 biggest shares on the American Stock Exchange, and some of those are companies that will trade globally. If you think about something like Microsoft, it sells product around the world, and the same for a lot of big American companies, but it's very specific to the US and what's going on in the American economy. Whereas I want exposure to China, I want exposure to India, to Europe, Japan and the like. And so, I want to buy things like Sony as well. I want to buy Ferrari, the share, not the car. I want to buy Porsche when it lists, and I want to access the Chinese market as well. And my view is, I think the next big economy in the world that will deliver great returns for investors is India. And I'm not going to get that through the S&P 500. So I'd rather buy the world, in the world index as a diversifier. No questions. So yeah, that's my big tip around starting out is, try not to, load up the credit card, try not to, spend too much money on a car, and then, get your emergency fund going and then start saving, into shares as fast as you possibly can. And just to be clear, you don't need to be a stock market expert. You can pay for a low quality unit trust and get as much return as you can from buying an exchange traded fund. I think it's about be aware of the costs, understand the product, do the homework yourself. I guess that's why you're on the Investment Society, and do some reading about investments. Listen to, obviously I'm going to be biased and say listen to this podcast, but listen to as many podcasts as you can, and try to avoid fashions. Try to avoid things that are doubling every 6 months or doubling every year, because unfortunately those things tend to fall over equally fast. And we saw that at the start of 2020. With investors buying a whole lot of shares through not through Reddit, but stuff that was promoted on Reddit, and what they were missing were kind of a whole lot of sharks that were promoting shares for their own purposes. They're kind of creating hype after they had bought them, and then trusting the goodwill of people on Reddit to get excited about a share that really wasn't a great investment. So be careful of hype. Hype's not a great way to get yourself to financial freedom. It is a great way to have some fun and potentially lose money. And I know that makes me sound old school, but it's amazing how these trends repeat themselves year after year after year. Okay, two questions. So from Brendan, besides your own books and podcasts, are there any other podcasts, websites, authors, or books that you recommend? Yeah, there are millions. So I think if you're really interested in shares, I think the all-time great share investor in history, and he's still alive today, is a guy with a similar name to mine. It's Warren Buffett. And he is just a phenomenal, allocator of money to shares, and certainly has a huge history in being able to choose fantastic businesses for periods of decades. And there's a great book by an author called Alice Schroeder, who wrote a book called Snowball about Warren Buffett. So it's certainly my favorite investment book. And then there is an author called John Bogle. He started a great business called Vanguard. He's written quite a lot of books. So I would read anything by John Bogle, because he's a great educator on markets, and certainly someone who's built up a huge fortune that he gave away pretty much most of it, based on stock market investing. Other podcasts, I guess I'm a little bit biased as well, but the Money Show, which is on 702 or Cape Talk, it's also a podcast. I think it's a brilliant, source of information. They have very good guests there, so I would do that as well. And then there's a great website called A Wealth of Common Sense, which is an American site, which I really like as well. From Ankush, thanks for your questions. The next one is, what would you recommend students who have a small amount of money at the end of the month do with that money to help them eventually gain freedom? So I think first point is build up that emergency fund as fast as you can to get to your three months of expenses, and then start investing. And as I said, some unit trust companies and some investment platforms will help you with amounts as low as $50, Ankush. And I think that's that's something really worth considering. And then I think we're running out of time, so I'm just going to take this last one. What is a feeder fund and how does it work? So just to explain, if you buy the top 40 index in South Africa as an example, and you now decide that you want to invest, let's say 100 Rand a month or $300 a month into the world stock markets, but you want to do it with rands on a monthly basis, there is a category of investments called feeder funds. And what that does is it'll take your rands and it'll go and actually invest that money overseas on your behalf. And so let's just say, if you buy the world index in a feeder fund, what that means is you'll take the money, you'll put it into a world index feeder fund in South Africa, and that money will then be fully invested in the world index overseas. And then you get the benefit of whatever the world index is doing. So if the world index is growing in dollars, you will get the benefit of that. But you also get the benefit of what the rand is doing against the dollar. So if the rand is really getting weak against the dollar, that will be good for you. It means your money will be growing faster. If the rand is going really strong, then that will be bad for you. But you get the hedge of the rand dollar as well as what the world markets are doing. And feeder funds are a really big class of investments in South Africa now. There are lots of unit trusts as well that are feeder funds that will allocate money to global bond markets, global money markets, global stock markets, or balanced funds as well. So really worth looking at. I think I'm going to wrap it up there. I think we're already out of time, but thanks for all the great questions. That was really exciting to chat to you, and I wish you all the best in your journey to financial freedom.
Brought to you by Prescient Investment Management. Informed by science, guided by insight. Prescient Investment Management is an authorized FSP.